Hi, my name is Sarah Beth, and I would like to welcome you to Thrive's Exit Loan Counseling presentation, where we will be discussing the ins and outs of paying off your student loans. So just as a little reminder, we hope that the information in this document and session is helpful. However, it's only intended to provide general education. It's not legal, tax, or investment advice and may not apply or be useful to your specific financial situation. If you need recommendations geared to your personal financial situation, please email us or speak with us after so we can determine how to best assist you. Any third-party resources or websites referenced here are not under our control. We cannot guarantee and are not responsible for the accuracy of the resources, websites, or any products or services offered through such resources or websites. None of the information in this presentation is sponsored. And lastly, this session does not count as a substitute for your mandatory online exit counseling session, which needs to be completed at studentloans.gov. Please make sure you also complete that session before you are done with your exit loan counseling. So here's an outline for our presentation today. First, we will go over key resources and terms. Then we will talk about federal loans, which is going to include interest rates, grace periods, repayment options, as well as benefits and forgiveness. And then we will talk about private loans, consolidations, and we will end with some tips and tricks. So first off, let's talk about some terms to know. So what is the difference between a lender and a servicer? A lender is an entity that is going to give you your loan. So for example, the government and the US Department of Education. Some other examples of lenders will be Sallie Mae, banks, credit unions, and other forms of these. A servicer is going to be a company that handles your billing and other services for federal loans. This is going to be assigned to you when you took out your loans. So some examples of these might be Aspire Resources, Cornerstone, Navient, and Nelnet. And in some cases, Northeastern may act as your servicer. So try to think of the lender as the bank, the person or entity that is providing the money. And think of the servicer as someone the bank uses to manage payments. They work in service of the bank. Let's talk a little bit about interest rates. There are two types of interest rates, variable interest rates and fixed interest rates. Variable interest rates fluctuate over time because they are based on an underlying market benchmark interest rate. Fixed interest rates do not fluctuate during the life of the loan until it is paid off. This allows the borrower to accurately predict their future payments because interest rates are locked in. Keep in mind that new loans are issued every year, which means that interest rates change. For example, the interest rate on a Stafford loan your freshman year might be different from the interest rate on a Stafford loan your sophomore year, and so on. If you take a look at the chart on the right, it's going to describe to you how interest rates have changed over time. Keep in mind that when the economy is strong, rates tend to rise. When the economy is weak, rates tend to fall. So for example, during our current pandemic, rates are falling. Federal interest rates are set each year by Congress, so they will differ by year. When you take out a loan in year one, the rate is set and then will not change. What types of federal loans are there? There are what we call a Stafford loan, and this is going to have two different types, subsidized and unsubsidized. Let's first talk about subsidized. These are available to undergraduate students with demonstrated financial needs. Not anyone will qualify for this loan, and you must show that you are in need of it. You can do this by filling out your FAFSA and other financial aid forms. The US Department of Education will pay the interest on a direct subsidized loan while you are in school at least half time, during grace periods, and during a period of deferment. An unsubsidized Stafford loan is available to undergraduate and graduate students and is not based on financial need, so you do not need to qualify for one of these loans. However, you are responsible for paying the interest on a direct unsubsidized loan during all periods. So that's going to include while you're in school, during grace periods, and periods of deferment. If you choose not to pay the interest while you're in school and during grace periods and deferment or forbearance, your interest will accumulate and be capitalized. We'll talk a little bit about what capitalization means a little bit later, but just so you know, it means that you will be paying more money over time as the principal balance will increase. So just to be clear, these are Stafford loans. So this is a specific type of government loan. So if you have other types of loans, this information may not apply to you. With an unsubsidized Stafford loan, we recommend that you pay the interest on these loans while you're in school, using either co-op money or money from a part-time job, as paying this interest off while you're in school will leave you with lower payments later. So there are other forms of federal student loans as well. So first of all, the Federal Direct Stafford Loan, and we talked about that can be subsidized or unsubsidized, has a 4 to 6% fixed interest rate and a 10-year repayment plan. The Federal Direct Grad Plus loan has a 6.41 to 7.9% fixed interest rate with an up to 25-year repayment. Keep in mind that with both of these loans, the interest rate is going to vary each academic year and will be determined by Congress. The federal Perkins loan is going to be a 5% fixed interest rate. It's subsidized and there's a 10-year repayment plan. And lastly, nursing and health profession loans have a 5% fixed interest rate. One thing to note here is that federal Perkins loans are no longer being given out. If you have received one in the past, you must continue to pay it, but they are no longer being given out. If you have a federal Perkins loan, your servicer will be Northeastern, so feel free to contact them directly. Let's talk a little bit about capitalized interest and capitalization. Capitalization is unpaid interest that has been added to the principal balance of a federal student loan. Future interest is charged on the increased principal balance. This may increase with the amount of your monthly payment and or the total amount repaid over the life of the loan. So essentially, capitalization is paying interest on top of your interest. So I'll give you a simple example. Let's say you borrow $1,000 with an 8% APR. After 1 year, you will owe $1,008. You will now begin to accrue an 8% interest on the $108, not the $100. So the second year, you will be paying interest on top of the interest you already accumulated. So let's stop and do a simple example. With simple interest, you'll have a loan, your first year will be at 10%, which is going to be $100 plus $10. Then at 5 years, you will still be paying that 10%, and it's going to be $100 plus $50. With compound interest on, again, a $100 loan, the first year you'll be paying the same, $100 plus $10. But at 5 years, you'll be paying $100 plus $61.05. This is because you're going to be paying interest on top of the interest you've already accrued. So this chart is going to give you a little bit of an example of how compound interest can affect you. So as you can see, at the beginning in those first years, you're barely going to notice the compound interest. It's not really going to be a large part of the loan, and you might not even notice it. However, as the years pile up, the compound interest will also pile up. So keep in mind that you would like to start paying off the compounded interest while you're in school so it doesn't compound as much. So let's talk about what a grace period is. A grace period is a period of time after graduation when you don't have to pay your loans and interest will not accumulate. Keep in mind, this is only for subsidized loans. If you have an unsubsidized loan, there may not be a grace period. Here are some examples of various grace periods. A direct Stafford loan is 6 months. A Perkins loan is 9 months. Keep in mind that a Perkins loan is no longer being given out. The Grad Plus loan has no grace period. A nursing loan is 9 months, and a health professions loan is 12 months. So as you can see here, grace periods are usually between 6 to 12 months for most loans. Also keep in mind that the grace period time will start to elapse if you take a leave of absence on school or if you drop below half-time student status. So here are the 4 repayment plans that are standard for paying back these loans. We have standard, graduated, extended, and income-based. Standard payment plan is going to be 120 payments over 10 years. This means that you will be paying once every month for 10 years. This is the only option currently for nursing and health profession loans. Then there's the graduated repayment plan. This is going to be small beginning payments and larger later payments, leaving you with a higher long-term cost. Then there's the extended payment plan, which is going to be over 25 years with smaller monthly payments, but a higher long-term cost. And lastly, we have the income-based plan. This is where your monthly payment is calculated based on your income. And in order to determine this, you will submit tax documents annually. With these four options, the standard is typically the most common plan as it is the simplest. You pay once a month for 10 years. It also is going to leave you with the lowest amount over time, but we will go into that a little bit later. If you expect to make more money at the later part of the 10 years, you may want to go with a graduated plan or an income-based plan. So now, imagine you are graduating this year with $50,000 of student loans with an interest rate of 6.8%. You're currently single, living in Massachusetts, and your first job out of school comes with a salary of $45,000. This is what your payment plans would look like depending on which one you choose. So keep in mind the standard and graduated are 10 years, and the extended fixed and the extended graduated are 25 years, and the IVR is going to be 12 years, 10 months. So the standard is going to leave you the lowest total amount paid with $66,011. The extended graduated plan is going to leave you with paying $103,257. However, you'll notice with these that although with the standard plan you pay the lowest total amount over time, your monthly payments are going to be more expensive. However, with the graduated and extended fixed and extended graduated plans, you are going to pay more over time, but less each month. So feel free to pause this slide if you want to take a closer look at how these different plans work. But keep in mind that you should choose the option that works best for you. Now let's talk about the difference between deferment and forbearance. So both deferment and forbearance are going to be ways to postpone your payments. Deferment is essentially another grace period, which we talked about previously, in increments of 6 months. You can qualify for a deferment if you are enrolled in school at least half time, if you are currently on unemployment, in the military service, or economic hardship. So an example of this would be our current pandemic. With deferment, interest will not accrue on subsidized loans, such as the subsidized Stafford loan, but will accrue on unsubsidized loans, like an unsubsidized Stafford loan. Another example of postponing your payment is going to be forbearance. For both deferment and forbearance, you must apply for these. So if you apply for a deferment and you don't qualify for it, you can then apply for a forbearance. A forbearance is going to be a postponing of your payment for up to 12 months. However, interest will still accrue on both subsidized and unsubsidized loans. This is going to be discretionary versus mandatory. So a deferment will be discretionary based on the lender. However, a forbearance may be mandatory and mandated by the government. You may qualify for a mandatory forbearance if you have a medical or dental residency, if your loan payment is above 20% of your gross income, or if you're in the National Service Program. Both of these are not automatic. You must request them if you go into a position where you need them. Also keep in mind that until you are notified that your request for deferment or forbearance has been granted, you need to continue to make payments or you will be considered delinquent. Please do not assume that just because you have applied means that you have and will be approved. So keep in mind that for your deferment and forbearance, you must apply and get approved before you can stop making payments. Let's talk a little bit about defaulting on loans. After 360 days without any loan payments, you will be considered to be defaulting. Penalties for this can include a damaged credit score, losing opportunity for additional aid, having your tax refunds withheld, or even a wage garnishment. Student loans are the only kind of credit that never goes away. Please keep this in mind if you are being close to defaulting on your loan payments. Also keep in mind that if you're in a position where you feel that you will default, keep in mind the deferments and forbearance that we discussed earlier could be an option for you. So there is some forms of public service forgiveness. However, this is only for now and will depend on the administration that we currently have. So in order to qualify for this, you must have 120 qualifying monthly payments under IBR while working full-time for a qualifying employer. Some qualifying employers are going to include federal, state, and local governments, nonprofit 501c3 organizations, nonprofits dedicated to qualifying public service, and the AmeriCorps or Peace Corps. This does not include partisan political organizations, labor unions, for-profit government contractors. Keep in mind that you must apply and requalify for this every year. The qualifications for these are going to differ depending on the current administration, and you must apply every year and qualify for different standards based on the year. Please never bank on having your loans forgiven if you are going into public service. So now let's talk a little bit about private loans. Private loans are granted by non-government organizations such as Sallie Mae, credit unions, etc. These are going to have fixed or variable interest rates depending on the organization, and they will always be unsubsidized. However, depending on the loan, they may or may not have grace periods, may or may not have deferment or forbearance options, and they may or may not have various flexible repayment options. So keep this in mind when you're looking for a loan and make sure you to read the fine print on everything. Also try to look for potential benefits and incentives with these loans, such as auto debit payments. With certain auto debit payments, you may pay a lower interest rate by paying automatically. So if you set your account to automatically pay this loan off every month, you may see a decrease in your interest payments. So now let's talk about consolidation. What is consolidation? Federal loan consolidation is when you combine federal loans to create one new loan. This is going to give you a new fixed interest rate and an up to 30-year repayment period. This may lower monthly payments, but not necessarily the total cost of the loan. So keep this in mind. Also keep in mind that you can only consolidate once. So if you know or think that you'll be going to grad school, you should wait until you take out all of your loans, both graduate and undergraduate, before you make the decision to consolidate. So as you can see with the example on the right, you can take a subsidized direct Stafford loan with an unsubsidized direct Stafford loan and a Grad Plus loan and combine it all into one new loan. So with consolidation, you can retain deferment or forbearance benefits, and you can combine subsidized and unsubsidized loans. However, you cannot combine federal and private loans currently. However, some programs are starting to allow this, so keep on the lookout for that. You cannot refinance an already consolidated loan, so you cannot reconsolidate twice. You can also not add new loans after consolidating or undo your consolidation. So this is going to be a permanent one-time action that you should think about carefully before you make the decision to do it. Especially now with low interest rates, it can be very tempting to refinance. However, there is currently no interest accruing on federal loans as we're in a pandemic. So take this into consideration when you make your decision to or to not refinance. So let's talk a little bit about private loan consolidation. You can replace multiple private loans with a single private loan. The variable interest rate is going to be just like the original loans, so it will be determined by your credit score. And there are no federal regulations on private loan consolidation, so make sure that you read the fine print. If you have excellent credit, you can often consolidate all of your loans into one jumbo loan at a low rate. So keep this in mind if you have private loans as well as an excellent credit score. So here are ways that you can take action with your loans. Know your servicer and their contact information. You can go back to the previous slides if you want some examples of who those will be. Understand the types of loans that you have. Understand if they're subsidized or unsubsidized, private or government, and consider the best repayment option for you. You can go back to those previous slides and try to understand a little bit better what you'll be paying over time. Also determine if consolidation is right for you. Keep in mind that you can only consolidate once. Also, check any additional exit loan counseling requirements. You must complete the mandatory online exit loan counseling at studentloans.gov. Again, this presentation is not a replacement or substitute for that mandatory counseling. Here we have some key resources for you. So studentloans.gov is going to be a great resource. Here you will complete your mandatory exit loan counseling. In addition, on this website, which I have linked here for you, there is going to be a loan simulator where you can plug in various loans, various payment plans, various interest rates, and make some decisions based on that simulator. There are also tools and resources on this website for student loan repayment and debt management. Also, there's the fsa.ed.gov. You will use this to find your FSA ID in order to complete exit counseling. This will give you access to federal student aid's outline systems and can serve as your legal signature. Keep in mind, Thrive is always a resource that can help you determine and make decisions for your student loans, as well as other personal finance decisions as well. So if you have any questions or you would like any personal time with Thrive, please email us at nuthrive@gmail.com. If you email us here, we will be able to give you extra information on loans, as well as any other personal finance topics that you would like to know more about. One of the amazing resources we have at Thrive is our personal finance advisors. You can set up a free appointment with them for a half hour, 45 minutes, or an hour and go over any personal questions you may have about personal finance. Also, be sure to check out our social media. Our handle is NUThrive, and feel free to DM us or check our social media for various posts on how to maintain good personal finance. Thank you again for coming to our presentation, and we hope to see you soon with other events. Thank you.